Picture this for a second. You walk into a bank, you look at the screen, and it says there's plenty of cash in the building. But when you actually try to withdraw, the teller leans in and says, yeah, most of that money isn't really available. Now swap cash with silver and swap bank with the big metal vault system behind futures trading. Because something just happened that should make every silver watcher sit up straight. The registered silver stockpile just took a hard hit, and about 4.2 million ounces got drained fast. That's not a normal daily wiggle. That's the kind of move that makes you ask, wait, are people starting a bank run on silver? And before you think this is just internet hype, let's slow down and make it clear, simple, and real. When people say registered, silver collapsed, they were talking about the portion of silver sitting in exchange-approved vaults that is actually tagged and ready to be delivered against contracts. It's the available to withdraw pile, not the might be available if someone decides to sell pile. So when that registered number drops hard, it raises one basic question. If more people want delivery at the same time, where does it come from? Quick favor before we go deeper. If you like clear breakdowns like this, hit the like button and subscribe. I'm going to keep this channel focused on the stuff that actually moves the market, not the clickbait. And subscribing helps you stay ahead of these shifts because when the numbers change, they usually change fast. Now, let's talk about what a 4.2 million ounce drain really means in plain English. Silver is a smaller market than most people realize. A move that sounds small compared to stocks can be a big deal here, especially when it comes out of the registered category. Think of registered as the ready inventory. There's also eligible, which is silver sitting in vaults that meet standards, but it's basically owned by someone who hasn't committed it for delivery. Eligible is like a car in a garage that could be sold, but the owner might say, not for sale. Registered is the car on the dealership lot with a price tag on it. So when registered drops, one of two things usually happened. Either that silver got delivered out, meaning someone basically said, I want the metal, not just the paper. Or it got reclassified or moved in a way that reduces what is immediately available for delivery. And this is where the bank run analogy comes in. A bank run doesn't start when the bank has zero money. It starts when people lose confidence that the money will be there when they need it. In metals, the stress shows up when deliverable supply tightens, while demand for real metal stays strong or even rises. Now you might be thinking, okay, but does this actually matter for price today? Great question. The price you see on your screen is heavily influenced by paper trading, futures contracts, options, algorithms, and large funds moving in and out. But the physical side matters because it's the foundation. If the foundation starts cracking, the paper market has to adapt. That adaptation can show up as rising premiums, backwardation, delivery delays, tighter spreads, or sudden violent moves when positioning gets crowded. Let me tell it like a story, because this is how these situations usually play out. Most of the time, the market feels normal. People trade paper, miners hedge, refiners buy, industrial users lock supply, and investors speculate. Then slowly, you start seeing small signals, more deliveries than expected, higher premiums on coins and bars, certain products going out of stock, and vault numbers quietly trending down. At first, nobody cares. Then one day, you get a headline number like a 4.2 million ounce drain, and everyone suddenly notices the same thing at the same time. And when everybody notices at once, the next question becomes, is this a one-time event or the start of a trend? Here's what I want you to watch with me as we go through this. Not just the single drain, watch the pace. If registered keeps falling week after week, it changes the conversation. It turns interesting into pressure. And if it happens while industrial demand is strong, think electronics, solar, EV supply chains, medical uses, then that pressure doesn't go away easily, because unlike gold, silver is not just a store of value metal, it's a working metal. A lot of it gets consumed, used up, and it doesn't come back quickly. So when you get a physical squeeze, silver can behave differently. It can stay quiet for a while, and then move like it's been waiting for a match. So what could be behind this 4.2 million ounce drain? There are a few realistic explanations, and none of them are boring. One possibility is straightforward delivery demand. Someone stood for delivery and took metal out. Another possibility is that vault owners moved metal from registered to eligible, basically saying, I want it in the vault, but I'm not offering it for delivery right now. That alone can tighten the available pile, even if the metal is still sitting in the same building. Another possibility is shifting inventory between vaults, or logistical moves tied to financing deals, leasing, or arbitrage. And if you're wondering, why would anyone bother playing these games? Because in a tight market, control over deliverable metal is power. It affects spreads, it affects lease rates, and it affects who blinks first when there's stress. Now here's the emotional part of it, and I mean that in a market psychology way. When people see registered dropping, it triggers a fear response in some traders and a confidence response in others. The fear crowd says, something's wrong, get safe. The confidence crowd says, this is exactly what we've been waiting for. When those two crowds collide, you get volatility, and volatility is where big money gets made and lost. Let's get into the mechanics, but I'll keep it simple. The reason registered matters is because it S the closest thing the public can point to and say, that's the pile that's supposed to back deliveries. It's not perfect, and it's not the whole story, but it's a real-time stress gauge. When registered drops by millions of ounces, the first thing I ask is, what NS the ratio between paper claims and deliverable supply right now? Because futures markets run on confidence, they work because most people don't take delivery. They roll contracts, close positions, or settle in cash. That's normal. The system is designed for that. But if enough participants decide at the same time that they want the metal, not the cash equivalent, the system gets tested. And here it's the key detail. The test doesn't require everyone to take delivery. It only requires more than expected. That's why these inventory shifts matter. Now let's address the question. If supply is tight, why isn't the spot price already screaming higher? Because there are basically two markets that talk to each other, but they don't move in perfect sync. One is the paper price, fast, liquid, traded in huge size and influenced by macro factors like interest rates, the dollar, risk-on, risk-off moves, and fund positioning. The other is the physical market, slower, constrained by logistics, fabrication capacity, and actual supply chains. Physical tightness often shows up first in premiums, delivery times, and product availability. Then, if it persists, it can start pulling on the paper price like gravity. Think about it like a rubber band. The paper price can stretch away from physical reality for a while, but if the physical market stays tight long enough, the rubber band snaps back. The snap can be sudden. So what should you watch next beyond the headline 4.2 million ounces drained? Watch whether registered continues to trend down. One big drop is a warning. A series of drops is a pattern. Watch whether eligible rises while registered falls. That can mean metal is still there, but being withheld from delivery. Again, not automatically bullish, but it's a tightening signal. Watch spreads in a futures contracts. Watch for backwardation, where near-term prices get stronger than later months. That's often a sign that immediate supply is valued more than future supply. Also, watch what happens in retail physical markets. Are coin shops charging higher premiums? Are online dealers showing back order more often? Are 1,000-ounce bars, what the industrial world cares about, getting harder to source at normal terms? You don't need perfection here, you just need to see the direction. Now let's talk about the bank run framing, because it's dramatic, but it's useful. A bank run is not just people withdrawing, it's a feedback loop. One person withdraws, the next person hears it, then more people withdraw because they don't want to be last. In metals, the equivalent feedback loop looks like this. Inventories drop, people talk about it. Some participants decide to take delivery just in case. That causes more inventory draw, and then the market either brings in new supply at higher prices or changes the rules of the game by making it more expensive to take delivery. And yes, markets can respond in ways that frustrate people. They can raise margins, change position limits, or create incentives to settle in cash. I'm not saying that will happen. I'm saying these are the levers that exist when stress increases. Now, I want to give you 3 realistic scenarios that could follow a big registered drain like this, and I want you to tell me which one you think is most likely when we get near the end. Scenario 1, it's mostly a one-time shuffle. Metal moved categories or a large delivery event happened, and then things stabilize. In this scenario, the market absorbs it, and price might not do much immediately. But even here, the message is still important. Someone wanted metal, or someone wanted to control metal. Scenario 2, slow squeeze. Registered continues to bleed lower over weeks and months. Retail premiums stay firm, industrial demand holds up, and the paper market starts to respect the tightness. Price moves up, but not in a straight line. This is the kind of market where pullbacks feel scary, and then it rips higher when people give up. Scenario 3, acute stress event. Something changes fast, maybe a surge in delivery demand, a supply disruption, a major fund repositioning, or a macro shock that pushes investors toward hard assets. In that scenario, silver can gap higher, and the move can be violent. These are the moments where I'll buy later turns into I can get it at the old price. Now, I'm not here to sell you a fantasy. Silver can be frustrating. It can stay undervalued longer than you think. It can get slammed on days that make no sense. That's why most people quit watching it right before it gets interesting. But the reason silver people stay obsessed is because when it finally moves, it can move in a way that shocks even experienced traders. So let's connect this to the real world. Why would physical silver be getting pulled or reclassified right now? Industrial demand is one obvious pressure. Silver is essential in electronics and solar, and even when the economy slows, certain demand doesn't just disappear overnight because supply chains are long and contracts are locked. Investment demand is another pressure. When trust in currency, debt levels, or policy gets shaky, metals get attention. Even if gold gets most of the headlines, silver is the cheaper entry point for many people, and that matters on the margin. Then there's the quiet accumulation angle. Big players don't always announce what they're doing. They take supply when it's available, and they do it through channels that look boring. A vault report changes, a category shifts, a few million ounces leave, and months later, everyone realizes the tightness was building the whole time. Here, S, a question for you. If you were an industrial user and you saw deliverable inventory dropping, would you wait? Or would you lock in supply early, even if it costs a little more? That's how squeezes start, not from panic. From responsible planning that turns into a herd move. Now, none of this is financial advice. I'm not telling you to buy or sell anything. I'm telling you what the signals usually mean and why this particular drain matters. So where do we go from here, and what should you do with this information? Mentally, strategically, and practically? First, treat the 4.2 million ounce registered drain like a warning light on your dashboard. A warning light doesn't mean your engine exploded. It means you should pay attention before something expensive happens. The market just told you in its own language that deliverable supply got tighter, at least for now. Second, zoom out. One day doesn't make a trend, but it can mark a turning point. The big question is whether this drain was followed by more drains, or whether the system refills registered quickly. If registered refills easily, then the market is saying, relax, supply can show up when needed. If it doesn't refill, the market is saying, supply exists, but it's not eager to be delivered at today's terms. And that second message is the one that matters most. Because if metal is being held back, the only way to pull it forward is usually price. Higher price, better terms, or higher incentives. That's the part people miss. Tightness doesn't always show up as empty vaults. It shows up as reluctant sellers. Now let's talk about what you might feel as a viewer watching this play out. Silver is emotional. When it drops, it feels personal. When it rises, it feels overdue. The best way to handle silver, whether you're a trader, a stacker, or just curious, is to decide what game you're playing. If you're watching this for macro signals, silver is like a pressure gauge for the whole system. Trust in money, real interest rates, industrial growth, and liquidity. If you're watching this as an investor, then your biggest enemy is usually timing stress. Silver can go sideways and punish your patience. That is why inventory changes like this matter. They help you focus on fundamentals when price action is trying to mess with your head. If you're watching this as a short-term trader, then you already know the truth. Silver can reverse hard. Big inventory headlines can trigger moves, but they can also trigger traps. That's why you watch confirmation. Follow through in spreads and volume and continued drawdowns. Now let me give you a simple checklist of what I am personally watching after a registered hit like this, and you can copy it. I'm watching whether registered keeps dropping. I'm watching whether the overall vault totals drop, or if it's mostly category shifts. I'm watching retail premiums as a street level indicator. I'm watching the gold to silver ratio, not as a magic number, but as a sentiment gauge. And I'm watching macro conditions, rates, the dollar, and risk appetite, because paper price can overpower physical signals in the short run. And I want to ask you something directly. What do you think this is? Is it a real physical pull that signals growing stress? Is it a paperwork shuffle that looks scary but isn't? Or is it the beginning of a longer trend where silver gets harder to source at current prices? Because your answer to that question changes how you interpret everything that comes next. Let's also be honest about what could cool this off. If the economy slows hard and industrial demand drops, that can reduce pressure. If investors lose interest and move to other trades, that can reduce pressure. If a lot of metal flows back into deliverable status because the price moves enough to tempt sellers, that can reduce pressure. But here's the twist. Even those cooling outcomes often come with volatility first. Markets don't gently adjust. They test levels, they shake people out, and they overshoot both directions. That's why the bank run idea is so powerful as a metaphor. It's not about doom, it's about confidence. If confidence stays high that deliverable metal will be there when needed, the system stays calm. If confidence slips, people act earlier, and early action itself creates stress. Now I want to bring this into a real-life moment. Imagine you're a manufacturer and you need silver for production. Your job is not to predict price. Your job is to keep production running. So if supply looks uncertain, you don't gamble. You secure supply. That's not panic, that's business. And if enough businesses do that at the same time, they become the steady buyer that doesn't go away when price dips. That's one reason silver squeezes can be stubborn once they start. Industrial demand isn't a fad, it's a requirement. At the same time, investors can add a second wave. Investors show up when they smell imbalance. And when investors and industrial buyers overlap, the market can tighten faster than most people expect. So here is my takeaway. A 4.2 million ounce drain from registered is not something to shrug off. It's a signal. Maybe it fades, maybe it grows. But it deserves attention because it speaks to deliverability. And deliverability is the core promise behind paper silver. Now I want to hear from you, seriously. Drop a comment and tell me which scenario you think we're in right now. One-time shuffle, slow squeeze, or acute stress event. And why? If you've been watching the vault numbers or premiums in your area, share what you're seeing. That kind of on-the-ground info helps everyone connect the dots. And if you found this breakdown useful, share this video with a friend who's into metals or markets, because most people won't hear about these inventory shifts until after the move. Also, make sure you've resubscribed so you're done to miss the next update if we see another big drain or a sudden reversal. We'll keep tracking the numbers, we'll keep it simple, and we'll keep it real. Because in a market like silver, the people who pay attention early usually get the best seat when the story finally speeds up.